This is Mike Paulenoff, MPTrader.com, January 31st, 2010. This is the second installment of our Charts of the Week video update. We're going to look at the semiconductor index now, the SMH, on a monthly basis using candlestick charts. This candlestick chart is illuminating. Why? Let's look at the January candle. This is a major dark candle, a colored candle, which tells us that the close of the month was below the opening. Well, I would say so. The opening of the month was 28.35. The high of the month made a new high for the entire up move from November of 2008. The high of the month was 28.72. The low of the month was 24.53, and the close was 24.76. So here's the close. There was the open. This is a major reversal. In candlestick parlance, this is a major bearish engulfing candle on a monthly basis. In bar chart parlance, this is a key downside reversal month, not to be messed with. This is a serious bearish signal for the SMH, and we should keep that in mind going forward. No matter when we see any sign of hourly or daily chart improvement in the SMH, just keep this massive reversal candle in mind. All right, other things we should know about this chart. Let's draw the trend line from the March 2009 low through the January 2010 high. That trend line was broken in January at about 2085, 2090, somewhere in 2585 to 2590. That's a very bearish sign too, because we closed below the trend line. In addition, the 36 or 3-year moving average also, it was an impediment to upside continuation. In December it tried, it failed. In January it popped above the moving average but closed well below it. So in the future, the 36 or 3-year moving average has to be watched as a serious resistance plateau for the semiconductors. All right, so we've established the bearish candle, the trend line break. Where can it go? Well, you know, November and October provide support. So if we look for the support, I would say the support is in here. That is to say, in the 24.10 to $23 area. That $23 area is where the 12-month, 1-year moving average is rising. So the next spot, we closed at 24.76. The next spot is around 24.25, down to 23.50, down to 23, which implies somewhere around a 5 to 7% downside continuation before we should even expect support to show up for short-term traders to try to buy the semis. My suspicion is, because this is such a bearish candle, however, that the semis have changed trend completely, have reversed trend completely. That is to say, this entire uptrend, this entire up channel has been broken and reversed, and we're going to retrace most of it, especially if lower support in the $20 area is broken. Then I think the semis will test the lows. So for now, I would stay away from the semis. They're not a buying opportunity. No matter how cheap they look, this candle on a monthly basis is telling us to stay away.